Hey folks, and welcome to the Pipnotic Symposium for the 4th of March 2024. Today we're going to talk about Bitcoin. So I'm just going to run over a little bit here and see if we can find reasons both to hold and to sell so that people can make their own decisions. Okay, so personally, when I look at the price of an asset, I'm looking for imbalances. When I mean an imbalance, I mean I'm looking for voids in liquidity, which you can see when prices move very, very far in a very short period of time. And the reason this is important to me is because when you have a period of, let me change here, when you have a period of trading where prices move up efficiently and then they leave inefficiently, this is telling us something about the state of liquidity in this moment relative to this moment, and they're very different, okay, which is why the price of the asset is acting differently in these two different periods of time. Okay, so what I want to do is I want to consider asset prices based on historical supply and demand, because this is the way that I perceive price. Other people view things differently. They look at other metrics. Some people look at maths. They have a quantitative analysis, and it leads them to believe that they should be doing one thing versus another. Others are looking at moving averages, stochastics, RSI, CCI. I mean, 101 different things, because you can view the price of an asset via many different lenses, and so you have to find whatever it is that works for you. And for me, this works. And the reason it works is because the way I will explain it is that we have an order book, and the order book is relative to the institution I'm trading via. Okay, and so we have the top of an order book and we have a bottom of an order book. What happens when you move up to the top of the order book, the state of liquidity changes. And so up here, there's going to be different liquidity here than there is relative to the bottom. So if these little lines, each line represents some kind of a sell order, and the sell orders get smaller and smaller the lower you get. In contrast to that, below we have something similar happening, but we have the opposite. We have people who are looking to buy when prices are low, and they stop buying typically when prices are high, unless you're suffering from something called FOMO, or you don't know what you're doing, or you're doing something that you heard someone else do. If you're not focusing on the facts and you're getting all emotion about a trading decision, well, then you're probably going to make trading decisions that are detrimental. And so what I try to do if I'm trading Bitcoin or gold or the Euro USD or whatever else is I want to focus on this concept here, because it is very, very important. And it's not important because it's something I believe in. It's important because it's fundamentally what causes the prices of an asset to go up and down. Okay, this is really, really important. And so what I like to do, I like to see gaps between these orders. Okay, let me use a different color. We have a gap here, we have a gap here, we have some gaps here. Let's just assume that there was a gap there. I look for these gaps because they're very important to us. And if we remove this, and then we immediately look for something that would correspond to a gap on the price chart, we have one here, we have one here, we have one here. Okay, we have them all over the place, all over the place. This is a natural price behavior that applies in every conceivable market where you have buyers and sellers who are buying and selling from one another. And they mean a lot, and they're important. And the reason they're important is because if you have price of an asset that moves, let's just focus on this just here. We'll try and replicate that. We have prices trading efficiently, more or less efficiently here. And then they move down, which is again efficiency. We are rebalancing price, which is a good thing. And then prices move up. And then they trade inefficiently. They move sideways. They move up a little bit more inefficiently. They come back. Then they continue to move higher inefficiently, like they did here. move up, down, and then they move up. The state of liquidity here and here is not the same as a state of liquidity here. They're very, very different. Okay, and the thing that makes me a little nervous about buying or holding a position as prices poke up into this daily supply that you can see just here is that the buyers, as we saw on the graphic previously, there aren't going to be any. There are no buyers in here. There are no buyers in here. There are going to be a few buyers in here, and you can see that simply by the way price reacted when it was here. There are going to be buyers around here, around this area here. There are going to be buyers around here. There are going to be buyers around here. And I'm not going to do like a full in-depth analysis, but I am going to tell you that buying up here is not a good idea. And the reason it's not a good idea is because we are doing this. We've distributed here. Historically, prices went down, and we've traded inefficiently into a liquid side of the market. So prices traded very inefficiently up into here. So what does that mean? Well, that means that there are people who are going to look to sell here based on the price patterns that we can see here. This is a very, very common price behavior over here on the left side. This is what I refer to as a shakeout, where you have a price run, prices come down, they go higher, they go lower, and they come back before they move down like that. This is a very common pattern at an extreme turning point in price. And what's happening here is the intention here for the smart money was to drive prices lower. And the reason you know that is because prices traded inefficiently higher. They moved sideways inefficiently. We came down, we went higher, moved sideways, distributed, we moved lower, we tried to come back, we came back to the bottom here, and then this is where prices moved away from. What's happening here is the people who, in a situation where some traders are looking to buy breakouts to the upside, as soon as prices run higher, they're going to start buying. They're going to have their buy stops positioned here. As soon as price pops above, people are piling in. And where are their stops going to be? Well, their stops are going to be here, okay, below these most recent predictable swing lows. Okay, so there are going to be stops up here. There are going to be stops down here. The smart money knows this, and so they know if they need liquidity to facilitate the filling of their order, they know exactly where they need to drive price. What we have here is we have people are buying, and they say prices turned around. They said, okay, I'm going to sell. So they put their stops here, and they start to sell. As prices go down, they're feeling quite happy with themselves because they may be even in profit, but then prices start to move against them. Then they feel less comfortable about the situation, and they start to panic. And so what they do is they say, okay, I'm going to get out of my position. So they buy it back here. They get out of their position once they're at break even, roughly. Okay, some don't. Some wait until prices go above here. So they start to buy here. They put their stop losses here. They buy here, and prices go up. They're feeling quite happy about themselves. Maybe even they add to the position once we move above these highs here. They put in their buy stops here. Prices go up. They're feeling really happy with themselves. Prices go up. They're in profit. They feel great. Maybe they add to the position a little bit more. But in the meantime, the smart money, they have a different plan. Who was it that drove prices high above these highs? It was a smart money. Why did they do that? Because there's liquidity here. Okay, who is it that did this? This is a smart money. And why did they drive price down here? Because there's liquidity here. And so what happens in a situation like that is you have very frustrated traders. The guy who sold here lost his money. The guy who bought here lost his money. But this is a very, very common, very, very natural behavior of price at extreme turning points in price, tops and bottoms. You see this all the time on every time frame possible. Okay, and now prices start to move away. But one thing that is maybe not as it seems, and that is, what about the smart when they bought to drive prices higher? Are they still holding that position? Sometimes they are. Sometimes they are still holding that position, and so they are at a loss once prices move down. Okay, and so prices, as they move down here, they are at a loss for the amount that they were required to buy in order to drive prices higher. Okay, so they start selling, so their net in the green, prices go down. And what happens now is they're still holding that long position here. That's what this pattern is telling us. They're still holding the long position because prices did not rebalance. If they didn't close them off at a small loss or break even as price broke away, they'll definitely be looking to sell out of those positions from here over here. This combined with the fact that we have a very beautiful area here. This is an area of demand. How do I know it's demand? Because it was used to consume supply. What supply? This supply here. This is supply. It was tested once. Okay, we formed a child below it. It was tested one time. This one removed the child, which is here, and the parent, which is here. We removed it. Okay, prices went above. We tested this one, which is the one that removed these two, and now it's been removed. What area removed it? This is the origin of the move, and this is the price point that prices had to return to in order to remove that. Okay, but this is a slightly risky trade because we have a price inefficiency right here from this area here down to this one here. So we have an exposure of price just in here. Okay, so we can trade this, but we expect prices to return to the origin as they did just here. Okay, so what I'm trying to say is this is a highly liquid price structure. Okay, for the reasons we discussed a second ago. Okay, we have prices currently poking into a very highly liquid price structure, standing on very illiquid moves. Okay, this is a very low liquidity. This is very low liquidity. This is why prices can race up like that. Price moves quickest in the direction of the thinnest liquidity. Okay, so it was thin until we came here, then we stopped just here. This is essentially what's referred to as a liquidity void. And it's called that because we are void of liquidity here. There might be, if you looked at something like a market profile, then what we would have here is that you would have bearish liquidity above price, just here. And so it would be quite thick, the liquidity would be thick here. And then it would go down, maybe even to zero or almost nothing, until we got down to slightly liquid price points like this. Okay, and then if you go further down, maybe there's a little bit of liquidity here. We have another price void here, so liquidity dries up. Then we get more liquid here as price moves down to this price point. And down here, we're probably going to have a pretty liquid spot. So there's going to be a little bit of liquidity here, and then prices are probably going to fatten up towards the bottom here because here we have a liquidity base. Okay, and so what I'm seeing here and what I'm expecting to happen here is I'm expecting Bitcoin versus the American dollar to have a pullback and rebalance this and essentially this right here. And I think this is going to happen for the reasons that I just discussed a second ago. If you look on the weekly chart, and we have another look, let me remove all of these. Okay, what we have here, we have a similar thing going on where we have weekly supply. That's a big deal. That's a really, really big deal. Weekly supply, that's a very big deal. That's a lot of liquidity. And why prices could easily go through that is very, very highly unlikely. And the reason I'm saying it's highly unlikely is because when I look at my histogram that identifies these price points, last time prices came high, we did that. We had some peaks here. We had a peak here. We had a trough. Oops, that wasn't very well lined up. We had a trough. We had a peak. We had a trough here. Another one here. Then we had some minor ones here. Here. And now we have a really big one forming right here. What does that mean? Well, that means that we have a likelihood of prices beginning to bleed back into rebalance these price inefficiencies. And where are they going to go? Well, they're going to go to a liquid price point. And where do we have a liquid price point? Well, I can see now. I'll just do the analysis very quickly for you. Okay, so we need, when studying supply and demand, you need to identify highly liquid zones that have been consumed by opposing flows. You need to start assessing this narrative and moving backwards. And so we have to look for that first. And where do we have that? Well, we've got that here. We've got one right here. Okay, and this is interesting for us because we had this here. Okay, this one was respected. You can't see, this is probably a daily or a 4-hour zone. I'm guessing a daily zone. It was tested. Now it's gone. What area removed it? This one did right here. This one is in play. It's been tested. But now it's gone. What area removed it? This one did. This one has been tested once, twice, 3 times. Wow, that's a lot. That's a lot of testing. Here we had a bunch of tests. We had another test. But what area removed it? This one did. The software is pointing to it. This one did. So I think that prices are going to come down to this area here, keeping in mind of the fact that we do have some rebalancing to do down here. If we go to the daily chart, we can see this probably with a little bit more clarity. We can try at least, or maybe even on the 4-hour we can get. Okay, here you can see with a greater clarity. What was that? The 50, 52. So where's the 52 here on the 4-hour chart? It's around here. So this is what we're looking at here. So we can actually see, it right here. But there are a few things to note here. We have this little price nodule. That's fine. We had an increase in price. Prices tapered off. We accumulated, then we gapped higher. So we have this area here, and this is the buy zone. So prices will probably react at around here, whatever the price point is there. I have to zoom in to see that. I can't see that what that is. But this is not a very interesting area right here, and the reason it isn't is because this one alone. Actually, let me mark this off and look at this on the daily chart. We had this little zone here. This one was able to move prices through this one here. So this is a pretty important zone, and this is an important zone because this is the origin of the zone that moved prices below this little price structure here. And this is the one I spoke about earlier. Here we have this one, and we had the one just above price here, as you can see on this time frame. We have this one here. I can just do it over here so we can see a little bit better. We had this one here, and this is gone. And this is an interesting one because this is the one that did it. The slingshot was pulled back, and then we left. So this is an important area, and price just tore straight through it. Okay, so the origin of the move that did that is the place where you can see. I got to do here because I got my charts synced. You want to see, you want to follow the liquidity void down until you can see a liquid base, and you can see a liquid base here. Okay, is this a liquid base here? No, it isn't. Why not? This is a reaction to a liquid base, and so here we have, here we have the liquid base. Here we have the reaction to it. What does that mean? That means this is the parent zone and this is the child zone, and so prices will, if they do come back down, they will move through this very quickly. They won't even stop, and they will pause here. They will pause here at around the, what does it say, 50, is that 50,304 maybe? Okay, and they will pause here. Okay, and this is the slingshot demand, slingshot departure. Okay, and this one isn't even that good of a one. And why is it not? Because if I just move away, I mean, we had this like this. Prices didn't even manage to rally and hold away and then snap back quickly and leave. Prices, in fact, they went up a little bit and then they kind of just gnawed away at the liquidity in this area here. This area here, we got just to the edge of it, and then we left. Okay, and so looking at this and trying to find like the real liquid, the areas where we could expect prices to have a bounces, you have to look for the places where prices have not been rebalanced. And you can see we have a couple. I'll put the different tools so we get the price labels on it. We have this one. This is one we just spoke about. We have this one here. You can see here because we had test. Now it's gone. What area did it? This one did. We have this one. And below price, we have, again, we have to do our analysis. We had a zone right there. Tested, 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 removed. Tested right there. What area removed it? This one right here did. So there's something down in here. You can always see it. That's at the 29,000. This is at the 43,000, and this is at the 50,000. So here we have 3 zones we can watch for. So do I think the prices are going to keep going without looking back? There's one argument for that, and the argument is the halving. What does the halving even mean for Bitcoin? It means a lot. And in the world of supply and demand, which is essentially the only thing that's ever driving markets, is the halving means that the rewards for mining a Bitcoin go down by 50%. So we're reducing the reward for doing a lot of work by 50%. What does that mean? Well, that means that the people who are invested heavily in mining Bitcoin are going to get paid half as much to mine Bitcoins after the halving is over. This will potentially lead some of the miners to stop mining. And so what that does is that potentially caps the supply of Bitcoin. So let's assume here that we have 21 million Bitcoins. But we also have Bitcoins that were lost. Let's guess that maybe 5 million Bitcoins got lost. I had a friend in Spain, lovely guy, and he had a friend who had, I think he had like 7,000 Bitcoins, and his girlfriend wrote over his private keys with a film. And he spent 9 months in the fetal position under his table at home. That's terrible, but that happened a lot, because people forgot all about Bitcoin when it wasn't performing. Okay, so there's maybe we have 16 million left. Okay, and because there is maybe no longer a thesis for continuing to mine Bitcoin, maybe some of the Bitcoins won't even get mined. So maybe, I'm just guessing here. Let's say that maybe 3 million of them will not get mined. So that brings down to 13 million. So maybe we have a max supply of 13 million, where initially we had 21. Maybe we lost 5 million. These are fictitious numbers. I'm just guessing. This is just to help you understand the thought process for holding Bitcoin. Okay, we lost 5 million. So now we're down to 16. Maybe 3 million aren't going to get mined because the halvings are going to prevent people from wanting to do it because it's expensive to mine, electricity, hardware, resources, all sorts of stuff. And so if there's no incentive for mining Bitcoin, then not all of them are going to get mined. And so the supply is going to continue to contract also as these big hedge funds like BlackRock continue to buy super aggressively. Okay, and so the supply shrinks. What happens to the price of something when the supply tightens? It goes up. It really goes up. And so this is the only thesis for holding Bitcoin instead of selling it now and waiting for a pullback, because the halving is so close. If the halving was a year away, then it's a no-brainer. Then you would sell. I sold, and I'm happy that I sold. But I might be eating my hat in 2 months after the halving has happened, if prices just accumulate here for a position of time until after the halving and just go north, because of the things that we spoke about here. I mean, that is also potentially likely. Okay, so looking at price, looking at the flows of liquidity in and out of Bitcoin, relative historical price points and patterns that we discussed here, doing liquidity distribution analysis, it would make sense, at least for me, to sell, which is what I've done. But the halving, this is the thesis for holding. Okay, so I'm going to leave it at that. That's almost half an hour. But consider these things, and I hope some of them are useful to help you make a trading decision relative to your Bitcoins. Thanks for watching, and if you like this video, please like and subscribe. Thanks for watching.